So before understanding what is a combined leverage, let us understand what does the term leverage means. The term leverage in general refers to relationship between two interrelated variables. In the financial analysis, it represents the influence of one financial variable over some other related financial variable. These financial variables may be your cost, output, sales revenue, earning before tax, earning before interest and tax, earning per share, contribution, etc. Okay, now combined leverage means your operating leverage into your financial leverage. Okay, so operating leverage is defined as the firm's ability to use its fixed cost, right? And financial leverage is referred to as a firm's ability to use this fixed borrowing cost. Okay, so you can see the detail about operating leverage and financial leverage in the separate video. Now combined leverage will give you combined leverage is what? Your operating leverage into financial leverage. Okay, to understand this better, let's prepare one format of profit statement. Okay, you have sales. Okay, then you have variable cost. So variable cost is the cost which increases or decreases per unit of production. Okay, so that is basically depending on your units of production. Then sales minus variable cost, you get contribution. Okay, minus your fixed cost. Okay, so fixed cost doesn't change irrespective of change in the units of production. Okay, unless there is a change in the capacity of the factory. Okay, so fixed costs remain the same. So after this you have earning before interest and tax minus your interest expense. So then you have earning before taxation. Okay, minus your tax. So you have earning after tax. Okay, then when you divide this earning after tax divided by number of shares, okay, you have earning per share. Get earning per share. Okay, so your operating leverage will tell you how efficiently you are using your fixed cost. Okay, this is the operating leverage, whereas your financial leverage will tell you how efficiently we are using your interest cost. Okay, so now combined leverage will tell you, this is financial leverage. Now combined leverage will tell you how efficiently you are using your fixed production cost, okay, or fixed operating cost, and your fixed financial cost, that is your interest. Okay, so your combined leverage will tell you what will be the impact on EPS, okay, when there is a increase or decrease in the sale. Okay, so this combined effect of operating and financial leverage will be given by your combined leverage. Okay, now let us see the formula for combined leverage. So your combined leverage is equal to operating leverage into financial leverage. Okay, so if you are given operating leverage and financial leverage, you can just multiply it and find out what is a combined leverage. Okay, now operating leverage will be what? Your increase in EBIT upon increase in sales into what is your financial leverage? Increase in EPS upon increase in EBIT. Okay, so if you see the CBIT gets cancelled, so your formula for combined leverage is increase in EPS or percentage change in EPS, percentage change in sales. Okay, similarly degree of combined leverage is equal to degree of your operating leverage into your degree of financial leverage. Okay, now what is our degree of operating leverage and degree of financial leverage? If you have it directly, you can just multiply it and you will get degree of combined leverage. If you don't have it, then degree of operating leverage is contribution upon EBIT, whereas degree of financial leverage is EBIT upon your EBT. This gets cancelled, so degree of your combined leverage is contribution upon EBT. Okay, now we'll see an example and calculate combined leverage. Okay, so here it is given XYZ sells 1000 units at 20 per unit. The variable cost of production is rupees 14 per unit. The firm has a fixed cost of rupees 1000. Assume that the sale of XYZ increases by 40%. The present and expected cost and profits is shown as follows. So they have given the profit statement. So present and expected. So sale is 20,000, that is 1000 units into rupees 20. Okay, and expected sale is 28,000, that is 1400 units at the rate of rupees 20. Then less variable cost 14,000, that is 1000 units at the rate of rupees 14 per unit. Then 19,600, 1400 units at the rate of rupees 14 per unit. Okay, so contribution is 6,000 in present case, expected is 8,400, less fixed cost 1,000, it is same. Then earning before interest and taxes or operating profit is 5,000 and expected is 7,400, less interest, again interest expense is same, that is 2,000. Then earning before tax is 3,000 and 5,400, less tax at 30%, that is in case of present it is 30% of 3,000, so 900. In case of expected it is 30% of 5,400, that is 1620. So earning after taxes 2,100, 3710. Number of equity shares is 1000. Earning per share is 2.10, 3.78. Then we have given operating leverage. Okay, so 1.2, financial leverage is 1.67, and then degree of operating leverage and degree of financial leverage is given at the two level of sale, that is at the sale of 20,000, that is 1000 units, and at the level of 28,000, that is 1400 units. Now we are to calculate what is a combined leverage. Okay, so first we'll calculate the combined leverage. Now combined leverage, okay, we'll calculate it in the both the ways. Okay, we'll use the direct formula, that is operating leverage into financial leverage. Okay, so operating leverage into financial leverage. So how much is that operating leverage? 1.2. Financial leverage is 1.67, right? So your combined leverage is 2.0004. Okay, now we'll calculate it in the other way, that is combined leverage is equal to your increase in EPS upon EPS upon increase in sales upon your basic sales. So that is how much 3.78 minus, right, 2.10, the whole is divided by 2.10, the whole thing divided by how much is the increase in the sale. Earlier it was 20,000, it has increased to 28,000. So 28,000 minus 20,000, the whole thing divided by 20,000 again. Okay, so how much is that? 1.68 divided by 2.10, the entire thing divided by 8,000 divided by 20,000. Okay, so it comes to 0.8 divided by 0.4, that is 2. Okay, so since there is a rounding off, okay, there will be some difference, right? Now this is how we calculate your combined leverage. So in both the cases the combined leverage has come to 2. Okay, now let us calculate degree of combined leverage. Okay, so degree of combined leverage, we'll use both the formulas to calculate degree of combined leverage. So at 1000 units, okay, so first formula will be, we'll just multiply degree of financial leverage into degree of operating leverage, which is given here, right? So in first case it is degree of operating leverage as 1000 is 1.2, financial leverage is 1.67. So 1.2 into 1.67, 1.2 into 1.67, so that comes to how much? 2.0004. Okay, now we'll calculate degree of combined leverage using the formula. What is the formula? Contribution upon earning before tax. So how much is the contribution which is come at 1000 unit? 6,000. And how much is the earning before tax? 3,000. So 6,000 divided by 3,000, so that comes to 6,000 divided by 3,000, so that again comes to 2, right? So thus it's cross checked. Now we'll calculate degree of combined leverage at 1,400 units sold. Okay, again DOFL, that is degree of financial leverage into degree of operating leverage. So at 1,400 units, what is the degree of operating leverage? Is 1.13 into 1.3703. So 1.13 to 1.3703, so that comes to 1.55. Okay, so now we'll calculate degree of combined leverage using this formula, thus this contribution upon earning before tax. So that comes to how much? What is the contribution here? At 1,400 unit, contribution is 8,400. Okay, what is the earning before tax? 5,400. So 8,400 divided by 5,400. So it, how much does that come to? 1.55. So it's same, right? So this is how we calculate our combined leverage. Okay, so what does the combined leverage signify is changes, okay, changes in your earning per share with a increase or decrease in the sales. Okay, so a high operating leverage and a low financial leverage will indicate that management is careful, since the higher amount of risk involved in high operating leverage, okay, has been sought to be balanced by low financial leverage. So if your operating leverage is very high, financial leverage is very low, we can see that management is careful. It is taking more risk, operational risk, than the financial risk. Okay, that is, it has kept its borrowing lower, whereas it is using its fixed financial operating cost at a very higher rate, or optimally using its fixed operating costs. Okay, So however, a more preferable situation will be to have a low operating leverage and a high financial leverage. So why is it that a low operating leverage would automatically imply that the company reaches its break even point at a low level of sales, okay, and therefore the risk is diminished. Okay, so it's better to use your borrowings efficiently and keep your operating leverage at a low level and financial leverage at a higher level. That is more beneficial. Okay, so once you calculate your combined leverage, you can bifurcate it into financial and operating leverage and accordingly analyze how much risk that is required to be taken at that particular level of sale. Okay, so this was about combined leverage. Thank you.